There's an old Wall Street line that goes back decades, and it's been true. It's don't fight the Fed.
Yeah.
And so if you can get the direction of the Fed right, a lot of times you can get the direction of the market right. And I think right now, the overarching bid is that rates are coming down.
All righty, folks, we've got Taylor, a 12-year Wall Street veteran who now runs one of the fastest growing, I'm going to call it funds managing high net worth individuals. That's my talk. That's not his. But again, we'll see how close I am. But I want to talk about jobs, inflation, the big, beautiful bill, and perhaps most importantly, earnings, because we are on the cusp of earnings season. Taylor, how you doing, buddy? What's going on?
Doing great. This is we just got a confluence of things coming together here. It's everything from the jobs report came out last week, pretty solid, better than expected. We've got earnings coming up here. We also got a little tariff noise going on. We've got a little bit of everything here. Big, beautiful bill. Moving on to the next step. Here we go.
There you go. So I guess the first thing that I have been putting out into the universe is, for the last couple of months, I've been talking about uncertainty. 6 weeks ago, maybe 7 weeks ago, I called peak uncertainty.
Yep.
And it does feel like it's getting brighter and brighter and brighter with every passing day. And I'm just curious if you're seeing that, or maybe I'm just, in an echo chamber and I'm only listening to myself.
Well, it certainly feels that way. And the market definitely is reacting that way in general. Yeah, I mean, from like just starting on the jobs perspective, the jobs continue to be not outstanding, but not terrible. And I think that's a big argument, is that folks were saying, hey, we're going to see this massive slowdown from a jobs perspective, and businesses at large are not slowing dramatically. They're not firing, that's for sure.
Yeah. When you look at the jobs number, it was really interesting. Before it came out, I think the odds of a July rate cut got as high as 21. They're now under 4, if not lower.
Yeah.
September now, I think, is sitting at 66%.
Yep.
This really just goes back to the fact that Powell's really focused on July and August, right? This print and next month's print, base effect, tariff impact. He doesn't want to be cutting rates into a rising environment. Is that fair to say?
Oh, totally. And I think the tariff thing is the big outstanding question mark right now, where, I mean, if you look back 2 months ago, whatever it was, 3 months ago, it was hell in a handbasket. Tariffs were going to cause, and we haven't done anything. Like in all actuality, we've got 3 deals. The most recent one, we have no idea what it looks like. So we got the UK, we got China, and we quote unquote got Vietnam, but no one knows what the Vietnamese deal actually looks like. And so now we have this threat outstanding of, all right, if you don't come to the table, we're going to boomerang right back to Liberation Day tariffs on everybody. And the market doesn't seem to care. It's interesting.
Yeah, I think the market is kind of teasing out that, Trump wants to use this as a negotiation, right? He moved the date back, for example. Originally it was July 9th. Now it's August 1st. Who's to say it's not September 1st, in a few weeks?
And in all likelihood, it will be.
Yeah, exactly.
We got a lot of wood to chop between now and even August 1st.
No, absolutely. Absolutely. So again, the other thing that I really want to talk to you about, again, is earnings, right? So if we do have uncertainty clearing, we have a jobs market that is at least not falling apart. We're going to have a little head fake in inflation, I think, the next month or two, and then it gets really easy at the base effect. I mean, I'll put it out now. I think there's a very good chance that inflation's 2% by the end of the year, if not end of the year, January for sure. So it's going to be interesting where earnings come in. I think the big banks start next week.
Yeah.
And, I think there's a lot of people that took last quarter, right in the teeth of tariffs, to lower expectations. So we could come into this cycle with plenty of beats. Am I missing the playbook here?
No, you're not. And this is not indifferent than any year. What happens is earnings get set, and then they get ratcheted lower throughout the year, and therefore companies consistently beat. And so more so this year than typical, you've had earnings reductions across the board. And so we came into this year at 11% S&P 500 earnings target at year end. And it's been moving downwards since the start of the year. And so now you're somewhere in that 7-8 ballpark, and there's room to beat. Whereas, at 11, you would have had people really struggling on the S&P to come to that cumulative 11% earnings growth rate. And this is what happens every year. And, not faulting analysts. Analysts work in the community where they want to set a price that the company's going to beat. Let's
Right.
call it a spade on that front. So what they do is they set it where they think is best bet, and then typically they set it too high and it gets ratcheted down and companies beat.
Yeah. I'm curious if this is going to be kind of the reverse of last quarter, where plenty of companies not, take an opportunity to reset, but maybe we get a couple of bullish, kind of bets. And, there was a lot of expectations that there would be a downdraft over the summer in the stock market. If you look historically, the summer months are, sideways, chop or whatever you want.
Sell in May and go away. Right.
Exactly. So it's going to be interesting if this quarter if the playbook is different, because again, we haven't had an environment where tariffs came out of nowhere, which were really trade deficits, which created a whole bunch of noise 90 days ago. It's now seemingly clearing, and it'll be interesting to see what businesses report heading into the second half.
It's just an interesting environment right now, as I see it. There's so much going on. It almost feels like there's nothing going on. really, like we have a ton of tariff uncertainty. And I know it doesn't, just by way of what we've done in the last 90 days, which is nothing. It feels like there's nothing to be had on a tariff front. And it'll be interesting to see if that actually comes to fruition, that we just continue to push, kick the can, whatever it is. If we just drop everyone's tariff rate to 10% across the board, that's not accomplishing the goals that we set out to accomplish. So I don't think that they can just go back and say, all right, we're just going to, we got a budget deficit we're trying to chew through here, and therefore 10% tariffs on everybody are going to help us do so. Like, that was not the goal that we set out to accomplish here. It was to correct bad behavior and get a better stance for the U.S. at large. So I don't think that would be a win. I think the market would perceive that as a win because it would take uncertainty off the table, but I don't think that's what we're trying to do. And then on the other hand, on the positive direction from a market standpoint, you have this big, beautiful bill. And the big, beautiful bill certainly helps corporation because it puts indefinitely lower taxes on the table, right? Until someone else comes in and changes the corporate tax rate, they are stuck at this lower tax rate now, which is certainly good for corporations, which bleeds through to employment being positively impacted, which bleeds through to investing with, bigger profit margins if you're not giving away as much to tax. So that's good for the market. There's certainly some social aspects of it that could be argued that are not necessarily good for the lower end of the market, but that's, on the fringe of looking at the entirety of it from an investment standpoint, this big, beautiful bill was a win.
Yeah. When I look at the big, beautiful bill, the question I had for you is, will it get the 3% growth that Scott Bessent, right? Scott Bessent is always talking about the 3-3-3, right? That is 3% of GDP, 3% inflation, 3% growth. And this bill is being pitched as the growth bill. Now, again, a lot of the analysts or, people doing cost structures aren't giving them credit for that. Right? I think the expectations are for 1.2 or 1.3% growth. That's nowhere near 3%.
Right.
But there's a lot in this that really could spur, an economy, I think. What do you think?
And it had better, right? Because otherwise the budget deficit ain't going to be 3%. So we certainly need that growth. And this is trickle down economics 101. And the thought process here is, although we're going to be paying a lower level of tax, this is going to stimulate the overall economy. There's going to be more revenue dollars at large. And even though it's a lower tax amount, the bigger base of the revenue pool will offset that lower tax amount and reduce our budget. Very few, I'll put it as, there are very few times in history we can point out that equation actually working to decrease the budget deficit, right?
Yeah, the last time was Clinton, right? Bill Clinton was like the last time.
Yeah, and the reality is what it takes a lot of, and we're seeing some of that now, is, a stock market that gets bigger and bigger and bigger can collect more and more taxes. So there's an argument to be made that like a bubble is needed in stocks in order to reduce the deficit, right? The 1990s .com bubble is what caused our deficit to come in. And that was a function of people selling stocks and paying short-term, long-term capital gains in a big way. And so a inflated stock market certainly can help from a budget deficit standpoint. And that's what happened in the 1990s.
Yeah. I don't know if you saw it this morning. Scott Bessent was on CNBC, asked about potentially taking the Fed job, leaving Treasury. And his answer for the first time was, I think, rather clean. It was, I'll do what the president wants. Other answers historically is I got a great job and yada, yada, yada. But this morning, his answer was very different. I will do what the president wants. So think Scott Bessent is the leading horse in the race?
I think so. This goes back to our conversation last week, right? We said that I think that he is the easiest suitor to pick out and in a very wild card type environment, right? Trump, love him or hate him, is a wild card. So you don't know what's going to come out of him. But I think that the easiest person to bet on right now would be Scott Bessent. And I think that was a very intentional change in.
Oh, for sure. That's what I read too.
That wasn't a random, hey, I'm going to say whatever comes to mind kind of perspective. He knew that was coming and he had that answer prepared.
No, and last week I was kind of hemming and hawing that, you'd want to keep Scott Bessent in Treasury. But as we got to the conversation last week, which you can find in your playlist, it was like, you know what? Scott's going to stay at Treasury till May. Right. That's a long time. That should get most, if not all, trade deals done. I mean, that's, I don't know, 10 months away. So it might make really logical sense. And I think the bond market would welcome Bessent as opposed to someone else that, because I think other people would be looked at as a whipping boy for Trump. And I think Scott Bessent has a reputation of doing the right thing. What do you think?
I tend to agree. I think he is a market technician. He is a market analyst. He is a market all things. I mean, that's where he made his billion, was in the market. So having someone else being able to navigate the shape of the Treasury yield curve better than him, I think it's a tall task to do so.
Yeah.
And like Trump, again, love him or hate him, when it comes down to, he had the greatest idea of all time for the U.S. debt during his last presidency. He said, listen,
term it out at 100 years.
That's exactly right. That's exactly right. Rates were at 0 at the time, and we could have booked 100-year debt at 2%, 3%. And maybe you're right. Maybe it was down near 1, but like there's an appetite for U.S. Treasuries, and there always will be until we F something up badly. And so when there's an appetite there and rates are low, you term it out as far as you can. And we didn't do that, unfortunately. And we're paying for that now because everything has been hyper short-term in nature. And so when you're booking out 3-month Treasury bills and we're facing an interest rate environment in 2022 that seems parabolic upwards, you're just booking at higher financing costs in perpetuity.
Yeah. Well, let's talk about Ray Dalio. Ray Dalio is getting very vocal, right? He's not a fan of the big, beautiful bill. He basically says this is going to be the thing that starts the cascade of terribles. But he's been on this shtick for a while. What are your thoughts when Ray Dalio comes out and repeats his thoughts?
He has, yeah. And he's going to be, this is one of those things where you're wrong forever. And then potentially you're really right. And he's got one of the greatest salesmen in the business on his side right now. And that's our man, Elon Musk, who is pounding the table on the same side. And I will give credit to Elon. I think a high profile figure like himself, and he's getting crushed by Trump for this right now, but he is the one to vocally speak up and say, we need a third party. And I think broadly, America agrees with him. Now, if you're a politician, you don't agree with him because you align yourself and you put yourself
one or the other, A or B,
or it's political suicide. But I think if you get a groundswell that's big enough, I think that there could be, in the next decade, it's going to take some time for them to build and formulate, unless they have, and let me be very clear, it's not Elon Musk. But unless they have a leader of that party that is a formidable kind of competitor, that is a well-known name that comes with a lot of notoriety in the front end, it's going to be that's what's going to be needed. And it's going to take a massive yeoman's effort to push that thing forward. But I think that 80% of America, I think there's a stat, 80% of America agrees that a third party would be helpful.
No, I would love a third party. I mean, that would be, more choice, more options. Works for me.
I think the vast majority of America agrees that they're voting on the lesser of two evils a lot of times.
That has certainly been my thought the last 20 years, is I'm voting for the person I like the least. Is that right? No, I dislike them. Whatever. You know what I mean?
You dislike the least. That was I think.
There were some horrible choices. But anyways, I'm curious. I think you're going to agree with Goldman Sachs. I read an article from Goldman Sachs over the weekend talking about they anticipate 3 rate cuts this year, which I think means September, October, December. So they're going to call it play by play at the end of the year, and 2 more by the first half of 26. So they're talking about getting the Fed funds rate all the way down to 3% by the summer of next year. Where are you at in this?
They've been pretty darn bearish, Goldman Sachs as a firm in general. What they're going to need is they're going to need some weakening of the labor market.
Yes,
or they're
for
just going
sure.
to need massive weakening on the inflationary data, which I think it's hard to say that will happen as quickly as it needs to happen in order for 3 rate cuts to come throughout the end of the year. I've been in the camp that we are due for rate cuts. I think that the labor picture is a scarier one than the inflationary picture at this point.
Yeah, I'd
I
agree.
can't imagine what it would be like if we were at 2% or 2% inflation by the end of the year, like you forecasted earlier, without rate cuts coming. I mean, Trump is going to lose
his mind.
And it can't happen. It can't happen that inflation goes that low without interest rate cuts coming. But Trump will be. He might put him in a headlock. He
might get physical. That's funny. Well, let's talk about Ed Yardeni. Ed Yardeni, way back in the day, got quoted as creating the term bond vigilante. So shout out to Ed. But he's basically saying the bond vigilantes will police the deficit and act accordingly. I think we got a little taste of the bond vigilantes about 6 weeks ago when all this tariff stuff came out. I think that Scott Bessent knows, and I think Scott Bessent was the one that went to Trump and whispered in his ear, "Dude, give us 90 days." So talk about the bond vigilantes and the fact that they will react in mass should things get wonky.
I think he's right. I think that's the function of a free open market on the bond. Just in general, I think what he's basically saying is the bond market prices risk of runaway deficits. And so what he's saying is if we continue to spend like drunken sailors, which again, love it or hate it, the big beautiful bill does allude to the fact that that's what we're going to do. It is very hard for politicians to say we're going to cut. People don't want to hear cut, whether it's in Social Security, whether it's in Medicaid, whether it's in Medicare, et cetera. They don't want to hear that. And so that perpetuates more and more spending. And as more and more spending happens, the risk of essentially the U.S. not being able to pay their debt increases along the way. And so then the bond buyer says, I need more for this given level of risk. And the interest rate, i.e. the debt financing costs of the United States balance sheet, goes up. And that's just the natural way of a market. If someone's in higher level of debt, you want to lend money to them less. And if you're going to lend money to them, you're going to require them to have a higher interest rate. And that's exactly what Ed Yardeni is speaking to. And he is exactly right.
Yeah. Well, let's talk about the market because, again, the market is at or near all-time highs. I think it's down a little bit this morning as we are recording, but let's call it near all-time highs. There was talk 3 or 4 weeks ago that retail was jumping in and Wall Street was selling. I'm curious, does your little spidey senses say that Wall Street might be dipping their toe back in the waters as we have avoided World War III, as tariffs have become clearer, as in, job market is what it is. Chances of September rate cut going up. Is Wall Street coming back in, or is this just all retail still?
I tend to think that this is a little bit more retail oriented right now. It feels like there's this general malaise right now. And again, this goes back to my comment before of like, it feels like there's everything going on, but nothing going on.
Yeah.
And that's that kind of malaise that's being experienced. But when you look at, you need to have one of two views on the market right now. You need to have a view that either corporate earnings are going to impress, and thus justify the current multiple that's on the market at about just north of 22 times, which is historically expensive, or you have to have the view that they're going to get aggressive cutting in the back end of the year. And that can certainly spur on some growth, bring down debt financing costs, improve profitability, all of those things. There's an old Wall Street line that goes back decades, and it's been true. It's don't fight the Fed. Yeah. And so if you can get the direction of the Fed right, a lot of times you can get the direction of the market right. And I think right now, the overarching bid is that rates are coming down. And, Powell's doing his best to thwart that.
Delay.
Yeah. But the market, has continued to perpetuate upwards, and deregulation and lower tax, like that is awarded in the market. And that's what we're seeing.
Yeah. Well, let's kind of wrap this up. We're already into the second half of 2025. What are your thoughts on the chances of a recession actually occurring this year? Do you think there's no chance, little chance, big chance?
It's funny. I think it's odds on are that there's no recession, right? So you have to have a view that unemployment's going to pick up demonstrably, I think, in order to get to a point where you can say recession is going to take place. And just the numbers are just so consistent. It's so consistent as to the hiring and the lack of firing, right? That there's a reality of it. And there's some nature of like demographics where you have baby boomers that are retiring right now. So that's not going on unemployment, et cetera. And so there's that tailwind from that against unemployment moving markedly higher. But I think you have to have a pretty negative sentiment as to the change in course in employment right now in order to wrap your head around a recession's likely.
Yeah, I think that's right. What do you think the chances are we print a 3% GDP growth sometime this year?
I don't think it's very good. I think there's too much swirl, too much uncertainty, too much growth that needs to be happened. The rate of change needs to pick up meaningfully. And I don't think that the tax cuts, et cetera, I don't think they bleed through quickly enough. And the realization from a CEO perspective is not quick enough to start the spending spree that needs in order for that to take place.
Yeah, because that's the big thing for me. It's like, it's great to see that uncertainty is clearing, and I think it's hard to argue it's not, but that doesn't mean decisions are getting made, right? We've clearly seen businesses and frankly, families and consumers delay. They won't do that forever, but they certainly feel like they're still doing that.
Yeah, and the tariff thing is still outstanding. Like if your supply chain is attached to anyone that has this delay still
anybody but the UK.
Anybody but the UK, you're exactly right. And then and it's still this weapon of mass destruction that Trump is wielding, where he says, listen, if the BRICS do anything to move away from the US dollar, is essentially what he's saying there. If they try to do something currency wise and start to exchange in a foreign currency, then additional 10%. Bang. Yeah, that was just yesterday. So it's still this weapon that he is there and going to wield, and he's going to use the power of the US economy and our consumer, which is the largest base in the world. It is the economic growth driver of the world, and that is a weapon that he is going to utilize.
Yeah, the last one I'll ask you is just about tariffs. I mean, when you think about what tariffs are going to actually bring to the Treasury, it's got to be north of 200 million, right?
I don't know the numbers about it. What was the number that you threw out there?
200 million. Because I think somebody you're talking about it potentially being 300 or 400 million. So I went low on purpose.
Billion?
Yeah, billion. Sorry.
Billion.
Yeah,
I was just saying,
billion.
I haven't done enough math. I wouldn't be able to give you an educated context on that as to what we're importing, what the overall cost is.
But I think it's fair to say that, we have been collecting tariffs before. So I think it's fair to say that we're going to 10x, 15x, whatever we had collected. So these will be record tariff collections going to the Treasury. So, and again, these are supposed to pay for no taxes on tips, retirement, all of those things. So
credit where credit's due at this point. I was not a proponent of tariffs. Let me be clear. Because I think that there aren't any, and we've had this conversation back and forth a lot. Like I said, listen, there's no point in history where you can point at tariffs and say that was a positive impact.
Yeah, Smoot-Hawley Act come to mind. Yeah,
exactly right. Caused the Great Depression, or at least extended and elongated
it. Yeah.
But at this point, where we are with tariffs, it's hard to make the argument that this was like this big.
Certainly not horrible.
Yeah, it's not been horrible. It's been business as usual for the most part. And maybe that's such hand in front of your face Taylor talking there, where you're looking, 45 minutes in the future, and you need to get a little bit more extended than that. And that's what the Fed's saying. The Fed's saying that we are going to see meaningful price increases and, detrimental behavior, but it's not there yet.
Yeah. Taylor, where can people find you? You put out amazing stuff, 60-second chunks. I still have no idea how you do it.
Yeah, thanks so much. We're on Instagram and on TikTok at Life Goal Investments.
Thank you, buddy. Talk next week.
Thank you.